Hi, I'm Murdoch Gaddy, and thanks for listening to The Rate of Change with York Wealth Management. The Rate of Change is a podcast which explores the ever-shifting momentum of financial markets through the eyes of the leading managers in wealth management. In today's RoCast, I'm joined by Andrew Killesteyn, the portfolio manager at Palisade Investment Partners, to discuss the Palisade Infrastructure Fund and their Infrastructure Trust, plus the other funds. Andrew defines the infrastructure universe, discusses why they look only at particular Australian mid-tier infrastructure assets to invest in, and highlights the importance of these assets in the community. According to the January 2023 fund fact sheet, the trust targets income and growth, whilst their average return was 9.8% for the past 12 months, 8.5% for the past 3 years, 9.1% for 5 years, and they've averaged 9% since inception. We dive into most of the assets such as airports, wind farms, gas pipelines, ports, plus others, and I found the conversation on the Sunshine Airport quite interesting. He discusses everything from why they look for these assets to how the tender process works to acquire these assets. I really enjoyed his insights into the Australian infrastructure universe, so please remember to listen to the disclaimer at the end of the RoCast and keep your feedback coming. You can reach me at mgatti@ywm.com.au. And with that being said, I hope you enjoy this conversation as much as I did, so sit back, relax, and enjoy it. Andrew Killesteyn, welcome to the Rate of Change with York Wealth Management.
Thank you, Murdoch. Great to be here.
Absolutely. Why don't we kick things off, and can you give everyone a bit of an idea of how you got into financial markets, a bit of your background and a bit about yourself?
Yeah, sure. So I'm a Canberra boy originally, and at university I did economics and commerce. And so when I finished uni, I had the choice of either being an accountant, an investment banker, or an economist. And so I got a job offer from Deloitte in Canberra at the time, and sort of went down the accountancy path, and I think pretty quickly worked out that my heart lied in finance. And so I had a couple of friends actually that were at Macquarie, and applied for the Macquarie graduate program in Sydney, and fortunately was lucky enough to be offered a role there, and went into their infrastructure funds business back in 2005. And if you recall back then, that was around the time that really private investment in infrastructure was taking off in Australia. And if you can recall those three massive listed satellite funds: Macquarie Airports, Macquarie Infrastructure Group, which was the roads fund, and Macquarie Communications Group. They were the big three funds at the time, and it was great to get exposure to sort of what was undoubtedly the leader in infrastructure investment at the time in Macquarie.
So how did Macquarie lead to Palisade?
So I left Macquarie in 2012, and really that was around sort of trying something new. So I then went to Jarman, which is one of the asset consultants, one of the leading institutional asset consultants in Australia, and headed up their direct investments business, which was advising a lot of superannuation clients on direct investments into infrastructure projects. I was there for about 3 years, and then was lucky enough to move over to Palisade to sort of head up their portfolio function and investor function. So I've been there for the last 6 years and loving it.
So before we get into the details of Palisade, which everyone's interested in, the infrastructure space is quite an interesting one, especially what's happened in the past couple of decades. Can you give everyone a bit of an idea of what exactly is the infrastructure universe, in your opinion?
Yeah, so infrastructure is it's a set of assets that fundamentally these assets are essential for the efficient functioning of an economy, right? So we're talking about airports, ports, electricity generation, energy transmission, distribution. Digital infrastructure is a somewhat of a emerging asset class. It was emerging pre-COVID, but certainly the onset of COVID and the working from home and remote working sort of accelerated, obviously, data usage in the world. And so digital infrastructure is certainly one of those asset classes which is emerging more quickly than others. But ultimately, from a business sense and a business characteristic sense, infrastructure is very much monopolistic in nature, high barriers to entry. And so what that means from a investment fundamentals point is that it is often seen as a defensive asset class within a broader portfolio. And coupled with that, you do get strong and stable income yields. And so, when people ask me what role does unlisted infrastructure play in a broader portfolio, I think the key really is that it's an uncorrelated strategy to more traditional asset classes and provides that sort of balancing effect for the portfolio.
Okay, so that's essentially the universe. So what's Palisade's approach and their investment philosophy? And I suppose, as you said, you've been Macquarie, you've seen how they kick this all off. So I'm actually really interested into why is what Palisade's doing different? What's their niche?
Yeah, sure. So we are very much about mid-market infrastructure. Excuse me, and that's been a very deliberate focus of ours since we started back in 2008, and really at the time there we saw a gap in the market. Obviously, large cap infrastructure at the time was very well banked, right? So you think about your large capital city airports and ports. There was a significant amount of capital investing in those projects and a significant amount of interest. Mid-market infrastructure, on the other hand, was relatively untouched at that point in time. And when we talk about mid-market, we're talking about assets that are lower down on the size spectrum. And people often ask me, what size investments are you targeting? It can be quite hard to answer that because each sector is slightly different. But if we were to put a number on it, we're generally looking at assets of $500 million enterprise value, up to $1 billion. $1 billion would be a big transaction for us. And so our approach is very much targeting that mid-market space. Now, why do we like that space? It's really two reasons. The first is simply down to demand and supply, in that we believe, and I think our portfolio is evidence of this, that there is an abundance of mid-market assets for investment in the Australian market. When you compare that to the large cap space, the pipeline can be more driven by whatever the privatisation agendas of the state governments may be at a particular point in time. So we very much believe there is a greater supply of assets in the mid-market. And then on the demand side, if you think about the sort of traditional investors into infrastructure, it's been your Australian superannuation funds, your offshore pension funds, your offshore sovereign wealth funds, who have significant amounts of capital to invest, and they're generally the ones that have come up and pushed up prices, particularly in that large cap space, right? We don't tend to see those larger investors in the mid cap space just because of the scalability of mid-market compared to large cap. And so simply from a demand supply dynamic, we believe there's better pricing available in the mid-market, and that results in better risk-adjusted returns for investors. The other reason why we like the mid-market is around control, right? So any infrastructure manager will tell you that they have an active approach to asset management, and we do as well. We will tell you that. Now, what does that practically mean for us? That means that given the size of the assets that we're acquiring, we are generally able to, between our fund and our co-investment partners, able to acquire majority stakes in assets, if not 100% of assets. And what that means is that we're able to work very closely with the management teams of those underlying assets to drive value for investors.
How's the unlisted work differently to the listed infrastructure funds in the market? What's the pros and cons?
Yeah, I mean, with listed, you're ultimately buying a small stake in a company, right? And so you're very much with listed infrastructure is very much about the analysis of the stock itself and whether it's underpriced or overpriced, and what that means for your portfolio. Obviously, with listed infrastructure, you are subject to to market noise. And, I think a lot of people probably won't realise, or maybe they do realise, that they would already have exposure to listed infrastructure probably through their equities portfolios. Particularly in Australia, the listed infrastructure universe isn't big, right? So I think people have already got exposure to listed infrastructure in their portfolios already. When you look at unlisted infrastructure, it's very much a different mindset. It's an active approach to asset management. You don't get that volatility, right? So all of our assets are independently valued. And we can see, and we've got some charts that we can show investors, that you can see that the drawdown or the negative return in any period for our strategy versus listed strategies is markedly different, right? So I think the key difference between unlisted and listed is around that stability point of returns and not necessarily subject to market cycles. I won't go into an argument of whether listed or unlisted is better. There have been numerous papers put out by managers on both sides, and they're very self-serving, let's say, on sort of which is the better strategy. So we'll leave that argument for another time.
Well, I can just say from my perspective that they're tools in order to get a job done. Some work better in some macro environments from a liquidity standpoint, whilst others, if things turn ugly, you can get hurt quite badly, whilst the other vehicle, can weather the storm quite well. So you'd probably agree that the different vehicle may be more of a choice based on what's currently happening on a macro standpoint than on the micro.
That's right. It comes down to investor objectives and their need for liquidity, their tolerance for volatility as well.
Yeah, exactly. Well, look, the reason why we're here today is I really want to get a better understanding of what investment opportunities Palisade's currently offering. Our understanding, and what we want to learn about, is specifically on the infrastructure fund. So what vehicles are currently available? What's their mandates? And why have they been structured in that way?
Yeah, sure. So with respect to, so we have three vehicles across the business. Our diversified fund, which is our flagship open-ended fund. So it has exposure to 25 odd assets in the portfolio already, and that fund will continue to grow over time, and will continue to invest along the various sector lines within that fund. So that's our institutional fund, and that's where the majority of our institutional investors come through, like our superannuation funds and insurance clients. We then have a specialised renewable energy fund and social infrastructure fund, social infrastructure PPP fund, which are a government availability style cash flows. Now, those two funds are funds in their own right, and they're more for investors who want specific exposure to those particular sectors, but also our diversified fund invests in those funds as well. And that's how the diversified fund gets its exposure to renewable energy and to social infrastructure PPPs, right? So I think, when we're offering our strategy to clients, very much the majority goes through our diversified offering, because that provides exposure to ultimately everything that we do as a business. And so for the wholesale market, we have set up a specific wholesale feeder fund that invests into the diversified fund. Okay, so whenever investors invest into that feeder fund, they will not only get access to all future investments that we make through the fund, they'll also get access to the assets and the track record that we've built up over the last 15 years and the existing assets within the fund.
Okay. So how much money is currently in those structures?
So in the diversified fund, that's currently a $1.6 billion fund. I think it should reach $2 billion fairly shortly, given the pipeline of opportunities that we're looking at. Within the feeder fund itself, we've raised around $300 million. So that feeder fund is a meaningful part of our diversified institutional fund. And that feeder fund just sits alongside our other institutional investors within that institutional fund.
So with new capital coming in, do you take capital at any point in time and then let it sit there and wait for an opportunity, or do you try to get the deal first and then fund it? Can you give a bit of colour around that?
It's a very good question, and it is a fine balance. Obviously, unlisted infrastructure is an asset class where it can be quite opportunistic. So we can sometimes go 6 months, even 12 months without doing a transaction, because sometimes these transactions have a long gestation period in terms of either working with partners or developers or whatever it may be to bring a project to fruition. On the other hand, and this is sort of the experience that we've had of late, we can do 3 transactions in 3 months, right? So it just really depends. And so for that reason, we've tried to match as best as possible raising capital in the fund to meet those transactions. So in answer to your question, no, the fund isn't open all the time because we don't want a situation where people invest capital and then that capital sits there without a home.
And before we get into the really interesting part, learning exactly how the mechanics of that all work, how's the performance been? What are you targeting? I believe you have a income target and then secondly a growth component. How's that work?
Yeah, I mean, performance has been good. If we look at the 12-month numbers, generally we're targeting high single-digit net total returns on this strategy. I think the numbers over the last 12 months were 9.8%, so we're at the higher end of that return target. And then from a yield perspective, remembering my comments earlier that this is a some consider it a defensive asset class, but sort of without getting into an argument of whether it's defensive or growth, undoubtedly this is an asset class that produces stable income yields.
Why don't we use the phrase it's uncorrelated?
It's
to
uncorrelated.
Some market volatility.
That sounds good. And so generally we're targeting net yields of 5 to 6%, and certainly that's what we've been able to deliver the last 12 months. I think what's more pleasing though is the returns that we've been able to generate over the long term, and so our 10-year returns are currently sitting at around about 11% total return net, and around about 6% yield. So I think in some ways that is the more pleasing number for us rather than the sort of 12-month and 6-month returns more recently.
So with staying on the returns for a second, how were the returns impacted in a rate environment that pretty much went nearly to zero? And we've had probably the most aggressive round of rate rises we've seen in such a shorter period. Does the fund and the investment vehicles benefit from an uplift in the cash rate?
If I had a penny for every time I've been asked, how do you expect infrastructure valuations to perform in this latest market? So I think it's important to think about how unlisted infrastructure is valued, right? So it's valued typically on a discounted cash flow basis, right? These are very stable assets with predictable cash flows. And so it's not unusual that assets are valued using a 30, 40, 50-year cash flow model, right? And so one element of evaluation is the forecast cash flows, and then the other element of evaluation is the discount factor, the discount rate for those cash flows. Now, all of our assets are independently valued, and our independent valuers take a through the cycle approach to determining what an appropriate discount rate is. So in the last 10 years, we've had a period of significant fall in bond yields. We did not see discount rates fall in lockstep with those bond yields, and equally, we do not expect, and we have not seen discount rates increase in lockstep with bond yields. Okay, so are we sitting here saying that discount rates won't go up? No, I think there's definitely upward pressure to discount rates. Will they go up materially? No, I don't think so. The other side of the coin, though, is that remembering that this asset class, and in particular this fund, has strong CPI correlation, right? So our CPI correlation across the portfolio is 0.8. So what that means is that if there's a 1% increase in CPI above our expectations, that results in a 0.8% increase in the value of the portfolio. So very strong inflation correlation in the portfolio. And so the other side of the coin on valuations is that if there's high bond yields that are being implemented to target high inflation, that's actually a benefit for our portfolio. And we've seen this play out the last 6 or 12 months, whereby the portfolio has actually performed really well because it is benefited from high inflation. Because of the pass-through, because a lot of the underlying assets, they have inflation escalators in the underlying contracts.
Well, I have to dig into this a bit. So inflation's been up now. Essentially, I think the research we're getting from the States says 80% of all central banks globally are currently in a tightening phase. Funny enough, China, first one to crash, maybe the first one coming out of this mess, and it's benefiting the iron ore sector. But if everyone's tightening to essentially put a lid on inflation, and there's an argument that our good old central banks and governments pretend to either do a handbrake turn, north or south, or I think the expression running around town is project break everything. If that's their intention to essentially drive it from a disinflation environment into a deflation environment, which there hasn't been many in like 70 years, how's that going to impact an investment vehicle, which, as you said, benefits on a 0.8% correlation to the movement in inflation?
We're fairly, to be fair, we're fairly agnostic to what happens with inflation, right? The key for us is ensuring that we have inflation protection in the portfolio to ensure that real returns of investors are preserved, right? So if inflation goes down and there's a big tightening cycle, then the reverse happens and we expect to see benefits in other parts of the portfolio. Discount rates will likely come down a little bit. Again, they won't go down in lockstep because of the through the cycle approach that the valuers look at, but there'll be less upward pressure on discount rates, and lower discount rates pushes values up, right? So I think it's very important to consider both sides of the coin with respect to the discount factor that's applied to valuations and the CPI linkage. As I said, we're not necessarily investing for a high inflationary environment. We just want to ensure that real returns are protected within the portfolio.
Well, that makes a lot of sense. Well, let's talk about the specific assets in the portfolio, and maybe to give everyone a bit of colour, let's talk about the Sunshine Airport. And the reason I want to talk about this is both personal, and I find it very interesting. And I heard you just got back from Noosa as well.
I did, yes.
How good is Noosa?
Very good, very good. Particularly when you don't have kids. Yeah. Sorry, I do have kids, but I left them at home. So.
Yeah, look, my grandparents retired there about 30 years ago, so I think I was very, very lucky to be introduced to a beautiful Weldon Stewart caravan park before it turned into the mecca that it is today. I heard you guys were discussing that Sydney Airport is now the fastest growing airport in Australia?
Sunshine Coast Airport.
Sunshine Coast, sorry, yeah, the Sunshine Coast Airport. Is that still the case?
Yeah, it's one of. I won't say it's the fastest because I haven't seen the latest numbers, but certainly it is one of the fastest growing airports. And I mean, Sunshine Coast is one of the fastest growing regions in Australia as well, which obviously then translates into traffic that goes through that airport.
So there's not just airports in the portfolio, but let's just look at that, because what I want to understand is the start to finish of how's the tender process works. How do you identify this as you hit mid-market? Once you have the asset, how do you ascertain what needs to be improved, fixed? We're talking about a new runway. Is it going to turn the airport business as itself? It went from just having a couple of dodgy cafes, which we love, to now essentially being like a Stockland or a mini Westfield internally with all these fantastic stores. Like, so to repeat myself, the tender process, how do you identify fixing things? How do you manage the business, and what's the looking forward from here?
Yeah, so this transaction started with a tender process that the Sunshine Coast Council put out at the time, and at the time we had good experience in airports, so we already had Darwin and Alice Springs airports in our portfolio. And if you think about Darwin, it is a little bit of a similar story in that we've just taken that airport through a redevelopment, a terminal redevelopment. And so there are a lot of credentials that we could put on the table to the Sunshine Coast Council to show them that we would be an appropriate partner to drive this airport going forward. And it is very much a partnership with the council. It's not as though they sell the asset and then walk away. Obviously, they are heavily invested in ensuring that the service that is being provided at the airport continues to be top class, so they can attract visitors to their region. So it is very much a partnership that we have with the council there. But during the process, we obviously did our due diligence. Doing due diligence on an airport takes a long time, and we went through that process in terms of looking at traffic forecasts, and ultimately we were selected as the preferred partner for the council to then sort of own the airport and manage the airport. Now, a really key part of this transaction was the new runway, right? So the existing runway that was at Sunshine Coast Airport was a north-south runway along the beach. I don't know the exact stat, but there are a lot of aborted landings because of the crosswinds, right? And so the Sunshine Coast Council always had this this project plan of building a new 2.5 kilometre runway out to the northwest, and that does two things. It means that the crosswinds are not an issue anymore, but it means that it's able to attract larger aircraft as well. And that was really key with Sunshine Coast Airport is it's a huge catchment area. Sunshine Coast, 400,000, 500,000 people catchment area, right? Now, a lot of that catchment was being lost to Brisbane Airport because of the availability of flights. There were just not a huge amount of flights available at Sunshine Coast Airport. So, one of the first things that we did when we got in there and with the new owners is spent a lot of time working with the airlines and showing the benefits of the region, communicating with them about the new runway, and ultimately with a view to attract the airlines and further routes to the airport, right? So the new runway was completed 2020, I believe, and since we've acquired the airport, there was a Sydney and a Melbourne service. I think there was one Adelaide service and a seasonal New Zealand service. Since that time, we've added a Cairns service, a Newcastle service, a Canberra service, an additional Melbourne service. We've now got Bonza, the new budget airline in Australia, is their base at Sunshine Coast Airport, right? And so what that means is that there's always a return trip going back at the end of the day because that's where the planes ultimately live, right? So the airport is just, in terms of the route development and the additional networks and routes that have been put on, it's been a real success story. The other part of Sunshine Coast Airport is the property redevelopment side, and so it's not unusual that airports would have significant land banks that they can use for commercial property. And so, one of the things, and we obviously went through a sort of heavy consultation process with council and residents and etc., was the closing down of the north-south runway freed up a lot of land that we'll then able to sort of commercially develop. And so that's been a sort of additional project that we've been working on at the airport to help diversify the revenue streams, because remember that, and we saw this during COVID, right? It was a really tough time for the airport. And you look at Sydney and Melbourne, those big capital city airports, they would have a not insignificant amount of their revenue from non-aeronautical activities, right? And so that's what we're looking to do at Sunshine Coast, is really to grow that non-aero side of the revenue stream, and that helps protect against future shocks that hopefully won't happen, but may happen.
Well, it's a shame you don't do toll roads, because when the planes weren't flying, I would love for you to fix that Bruce Highway.
Yeah, right. That's right.
Bruce Highway is it's always the pain in the existence of trying to head up there. But so yes, it's great to hear about Sunshine Airport. So as you said, COVID happens, planes aren't flying, the portfolio is diversified. So what other asset classes or sub-asset classes are in the portfolio?
Yeah, I mean, one of the great things about mid-market, and again, I think you can see this in our portfolio, is that you do get a good exposure to a lot of different sectors within the infrastructure asset class. Infrastructure is not a homogenous asset class. You've got everything from social infrastructure, PPPs, which, as I said, are government availability cash flows. Essentially, you get paid a quarterly payment for making the facility available, as long as you meet certain KPIs. Very low risk assets. Then going up through the risk spectrum, you've got energy transmission, generation, you've got ports and bulk liquids, so port-side infrastructure like the big storage, the big white tanks that you see port-side, up to airports, and then digital infrastructure as well. So from a risk-return spectrum, it is quite a varied of opportunities, and within our portfolio, we've got exposure to most of those major subsectors. Transport and energy are probably the two largest, not probably, they are the two largest exposures within the portfolio. And they certainly going forward will be key focus areas for us to continue to build out along those sector lines. Digital infrastructure is probably the other area that we like. And so, typically we look to invest in sectors where they exhibit strong tailwinds and that we have expertise, right? That's sort of the two things that we're looking at. And so if I were to sort of think about where this portfolio is going in future, is very much transport and energy. We'll continue to build out those sector lines, but certainly digital infrastructure like fiber, data centers, etc.
When you say digital infrastructure, like I'm hearing some places, you buy a dam, the water, essentially, all the data centers underneath the water cools everything, but you don't have to go offshore, right? Is that something that you're looking at when you say digital infrastructure, or are you saying something completely different?
So digital infrastructure probably fits into three main assets in my view. It's towers.
Yep.
Right now, towers are great assets, but there's not many tower operators in Australia that would fall into the mid-market space. We've seen Telstra sell off their towers business, Optus sell off their towers business, Vodafone in New Zealand sell off their towers business. They've all been quite sort of extraordinarily large transactions with prices to sort of meet that. And so we do like towers as an asset, but I think in terms of getting access to that in the mid-market could be challenging. And so really, when we talk about digital infrastructure, the two main areas that we're looking at is fibre, so last mile fibre. We've just recently acquired a fibre business in the US and looking to roll out that network to other regions in the US. And then the other sector is data centers. So ultimately, storage houses for large amounts of data. And so that's something which we're yet to make an investment in yet. It can be quite challenging to enter that market if you're not an incumbent player. But we've been certainly looking at a few opportunities, and really the space that we're looking at in data centers is edge data centers. So you can sort of split it up into hyperscale, which are your big data centers that sort of Amazon and Microsoft own. And then you've got your edge data centers, which are actually smaller data centers closer to the user, right? And so, we feel that fits more within our mid-market strategy.
So what's the most recent acquisition in the portfolio? As you were saying, you find an opportunity and then essentially telling investors, we have an opportunity to get into the fund to essentially purchase this particular asset. So what's the most recent acquisition?
So the most recent acquisition is a wind farm called Stockyard Hill Wind Farm, which is down in Victoria. It is the largest wind farm in Australia at 528 megawatts. So it's a big one. And really that investment is an extension of our existing renewable energy strategy that we've been undertaking for the last 10 or so years, which is to build out a diversified platform of renewable energy assets. And so now that is our sixth asset in the portfolio. It takes our renewable energy generation portfolio to over 1.5 gigawatts. I heard the other day that that now makes Palisade the largest, or it now makes the Palisade platform of renewable energy assets the largest in the country from an operational perspective. In terms of our renewable energy strategy, it really is about looking to grow out that sector. And so I think, particularly with renewable energy, I feel that we're on the verge of a new build out of renewable energy in Australia. We went through in 2015, 2016, when we had this bipartisan support from the Labor and Liberal governments to put in place the renewable energy target, which mandated renewable energy retailers and large users to purchase 20% of their energy needs from renewable sources. That spurred a huge build out of renewable energy, from 2016 to 2020. We've then hit a bit of a lull the last couple of years, and I did any favours in that respect, but certainly the last 12 or so months, we've seen a real push to sort of further build out renewable energy in Australia, particularly given our ageing coal fleet. So we're very excited about where we can take our renewable energy platform, and as I said, we've got a good starting point, being one of the largest in the country.
So with the portfolio, as you said, that Palisade is now one of the largest renewable energy asset holders, so to speak. With wind farms, one question that comes up quite a lot is the reliance on subsidies. And there's some people argue that if tomorrow wind farms evaporate, like as an example, if the water rights, there are no subsidies, as an example, right? Then essentially that business may get impacted greatly. Is that a concern for you, or more importantly, how do you factor into dealing with that? What are your thoughts?
So new build wind and new build solar are absolutely economic at the moment without subsidies. So subsidies were brought in, and the key form of the subsidy was the renewable energy target and large-scale generation certificates, right? And that scheme runs out till 2030, and there's been no scheme put in place post 2030. There may be, depending on sort of the actions of the government, but at this point, there's no scheme post 2030. Having said that, if you were to go and build a new generation at this moment, so if you had the requirement for one additional megawatt in the network, the cheapest way to do that at the moment would be renewables. So coal, gas, you had all those options on the table, ignoring any ESG impacts. Renewables is the cheapest form of new build generation at the moment, right? So this asset class can now and is now surviving without subsidies. And so the way in which our investments are structured is we enter into long-term offtake agreements for our renewable energy assets. So if we're out there working with a developer on a new renewable energy asset, we will look to, before we put any dollars in the ground, we will look to ensure that we have a long-term offtake agreement in place, and that could either be with Origin Energy, an AGL, one of the big retailers. It could be with a state government counterparty, and we've got all of those counterparties now in our portfolio, and we will look to contract that power out for 10, 15 years or whatever it may be. Now, at the moment, there is no subsidy attached to that contract, right? So at the moment, for new build generation, there are no subsidies being underwritten. For the existing assets that we have in our portfolio, we have obviously get the benefit of the subsidies through the large scale generation certificates that we sell. But following 2030, there's no assumption in the model around those subsidies continuing, right? So I think it was early on when renewable energy was an emerging asset class, it was probably right that the asset class couldn't survive without subsidies. And we're seeing that with batteries at the moment, right? It's still probably at the margin if they are economic without subsidies. But we've seen this extraordinary fall in technology costs for both wind and solar components and technology. And that's basically made subsidies non-existent or not required because of that fall in technology costs.
Well, the access to renewable, cheap, reliable energy is very, very important for our society, right? And I agree with a lot of people when they say that we need to get it clean, but unfortunately, life doesn't always work out the way that we want. So there's also many people discussing that it might be a gradual step over the next 50 years, so to speak. And they're saying that, if you look at natural gas, that might be the least of all evils in the transition phase. I think I saw in the portfolio that you have infrastructure exposure to the gas space. Is that still the case?
Yeah, it is. And look, we very much remain supportive of gas as a transition fuel. We think it's absolutely fundamental to ensuring that we have an orderly transition to renewables. And
What's the asset?
so we got 2 gas pipelines in the portfolio, and these gas pipelines, they're similar in strategy in that one goes north and one goes south, right? So the one that goes south is our Tasmanian gas pipeline, and that takes gas basically from the Bass Strait and from the Victorian sort of mainland down to Tassie. And then the one that goes north takes gas from the Moranbah gas basin up to Townsville. But very similar strategy in terms of the role that those pipelines play, in that the one in the north connects into the Townsville power station, the one in the south connects into the Tamar Valley power station in Tassie, right? And so they very much provide the role as providing security, energy security to those regions when renewables or other forms of generation may not be available to provide power, right? So it's very much an energy security play, and that just sort of further compounds the point that we do believe that gas has a role to play in an orderly transition to renewables, because at the moment battery storage is not going to be able to play the role of that firming power, because you need firming power, right? The wind doesn't blow all the time. Obviously, the sun doesn't shine at night time, and so you need that complementary power. And so batteries are just not at the point, and probably will not be at the point where they can play that role to any large degree for several years. And so we definitely think that gas has a continuing role to play in the energy mix. The other thing to mention as well is that gas is still required by industry for sort of heating and other manufacturing purposes. And at the moment, electricity just cannot play that role. So, I think it's important to sort of remember that gas has a sort of dual role in the economy. It's going to be a transition fuel, but equally as well, it is a fundamental part of manufacturing in Australia as well.
That's what you're saying. Your team essentially looks for infrastructure that's difficult to be removed and, is going to be required for many generations to come, right?
That's right, yeah.
So speaking of the team, how big's the team now?
So the team is, so we split our team into investment personnel and asset management personnel. So in the investment team, we're around 30, and in the asset management team, that's close to 50 now. So we've got a team in Australia of around about 15, 20. And then we've actually got a team as well based in the UK who do a lot of our. We've got an anaerobic digestion platform that we're building out in the UK, and they work on that platform. So it is a scalable team now, and importantly, we think it's a good mix to have both investment personnel, but particularly the operational guys, right? So they're very much involved in the day-to-day running of these assets. They don't turn the spanners, but they manage the guys that turn the spanners, right? So, we think it's really important that we sort of augment that sort of investment capability that we have with actual guys that sort of live and breathe these assets on the ground.
Well, having a good team is very, very important. And I suppose our clients, one of the main questions they want to understand is essentially the behavioral psychology behind the alignment of the team and how they're remunerated. As we know, different remuneration structures is essentially, create different outcomes. So how is the fee structure and bonus structure work at Palisade? Secondly, is there a high watermark? What's the benchmark? Why is the benchmark chosen? And can you give a bit of an overview? That'd be great.
Yeah, sure. So the alignment and the remuneration, I think the key point is that 65% of Palisade is owned by staff, right? Which is pretty powerful, and that's consistent with the broader Pinnacle model, which is they take minority stakes in various affiliates and then provide back office support, distribution, HR, etc. So it's consistent with the broader Pinnacle model, but what that model allows us to do is, as an investment team, we can focus on what we do best, which is investing and managing assets. And so fundamentally, we are aligned through our ownership of Palisade. And so very simply, We have a short-term incentive and a long-term incentive at Palisade. Our short-term incentive is funded out of the performance fees that we generate for the business, and obviously those performance fees are linked to the performance of our clients' portfolios. And then we have a long-term investment scheme, which is the ability to participate in the equity of Palisade. So there's that long-term alignment, and there's also vesting provisions as well. So, heaven forbid if we decide to leave, you're always leaving something on the table, which is good. It's a good tool to ensure that people sort of remain with the business as a retention tool. And then also we've had several team members invest their own personal capital as well into Palisade as well. And I think having that LTI is really powerful, but when you actually put your own personal capital into the business, it really sort of sharpens the mind in terms of wanting to ensure that you are really delivering the best outcomes for your clients, because it's your own personal money at risk as well. So, I think the incentive regime that we've got at Palisade it strikes the right balance of fairness, of alignment and retention as well. In terms of how performance fees are structured across the business, you're absolutely right. It's a high watermark, and if there is underperformance against that high watermark, then we need to catch up to that high watermark again before we can start generating performance fees. Fortunately, we're not in that position where we're underwater. So,
what is the benchmark?
So the benchmark is a bonds plus a margin benchmark. So on the diversified funds, it's bonds plus 5%. And
why was that chosen?
Look, I think there's probably three main benchmarks you can choose within infrastructure. One is a CPI plus benchmark, and sort of that makes sense given the natural sort of linkages to inflation. One is a fixed benchmark, so 7%, 8% is not unusual in the current market. And then the others, which we've seen, is obviously a bonds plus benchmark. Now, in terms of why that was chosen, look, I think infrastructure being, we spoke before about being that defensive asset class. I don't agree with this, but people have often referred to infrastructure as a proxy for bonds. Given the defensive nature of the asset class, I can see why people say that, but personally, I don't agree with that. I think,
isn't that the argument essentially with COVID that commercial properties never come off and ever, and then all of a sudden you have a supply side shutdown, and nothing happens for 2 years. And
that's right.
So,
I mean, COVID did a lot of things to asset classes which people never expected, but.
When I get concerned when people say, "Oh, this has never happened," so it will never happen going forward.
Yeah. But anyway, so I think in that regard, there is a sensibility to having a sort of bonds plus a margin benchmark for infrastructure, and that's ultimately what was chosen for our fund. 15 or so years ago, that's been the benchmark since. And we think it provides a sort of good level of sort of alignment and performance benchmark for the team.
That's really good to get an understanding of. So, is there any thoughts you want to leave our listeners and clients with?
Look, I think the beauty about one of the things I like about infrastructure is it's real, right? I know it's a real asset, right? But you can see and touch it. You can experience it. I experienced it last week in Noosa when I flew into Sunshine Coast Airport. I hate to admit this, but it was actually my first time on the new runway, even though it's been built for 2 years. Yeah, so slap on the wrist for me. But like it was fantastic. It's a really great airport now, and I think it's we're turning our minds now to a terminal redevelopment for that airport, and so I think it's going to be really, really exciting. But that's just one example in the portfolio where you can actually visit, you can experience our assets. I was in Gold Coast last year with the family, and we had a ride on the tram, and that's something that we've funded, right? So it is nice from that perspective to be able to see and touch and experience assets that you're invested in. And I think the beauty with our portfolio is that, we don't just have capital city infrastructure. Given our mid-market focus, we are very heavily invested in regional Australia as well. So, we've obviously got our renewable portfolio, which given the nature of those assets, are in regional communities, but we've also got Port of Portland in sort of regional Victoria. We've got our livestock exchange agri-infrastructure business in regional Australia. So it's quite nice that we're able to sort of touch sort of various sort of communities with Australia, and that's really important to us as an infrastructure owner, is working closely with the communities, because a lot of the communities that our assets exist in, they rely very heavily on those assets to be able to live, right. So it's a nice, from that perspective, it's a nice sort of investment to be making. But I think if I could sum up the strategy in one word, it's access to a high quality portfolio of mid-market infrastructure assets that have both defensive characteristics, but also good levels of capital growth and good income yields as well.
If anyone wants to learn more about the strategy and the team, how can they reach you?
Pinnacle do a great job with us as our distribution partner. So you can either reach out to someone on the Pinnacle team. Their details are on the website, or please look me up on the Palisade website, and I'll be happy to assist as well.
Fantastic. Andrew, thank you very much for your time. It's been really, really interesting.
Thanks, Murdoch. My pleasure.
Have a good day.
Any views expressed in this recording do not represent the view of any other third party and are the sole personal opinions of the speaker. Any reference to financial product does not constitute advice or recommendation, and before any action, you should seek proper advice from your financial professional. Australian listeners should head to www.moneysmart.gov.au to find more information on obtaining financial advice. To get in touch with York, head to our website www.yorkwealth.com.au.